we actually have more flexibility when we're working with the borrowers to come up with creative solutions. If they're coming on tough times, which many people are in the marketplace, then as long as we have a trust factor back and forth, then we're going to be able to work with them and figure some solution out.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB & Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 266. According to the Mortgage Bankers Association, the delinquency rate for mortgage loans on 1 to 4 unit residential properties has reached the highest level since 2010, when we were deep into the Great Recession. Over 7.6% of borrowers are 90 days or more behind on paying their mortgage. In the midst of this national crisis, what effect is this having on investors who own and service their notes? And how are these investors working with their borrowers to provide forbearance and other options to keep people in their homes? Here to discuss the state of note investing during a pandemic is a real thought leader in the mortgage note investment industry. Martin Saenz brings social good into smart investing through his company, Bequest Funds, which acquires and profits from performing and distressed mortgages. He has directly helped over 1,000 families stay in their homes and countless more through the influence of his mentorship. Martin, welcome to the show.
Thank you for having me, Brian.
Why don't we start with you just telling our audience a little bit about yourself and how you got started investing in real estate?
Sure. After receiving my MBA in 2001, I went out and got myself a nice corporate job, as you know, as that's what you should do after getting a business degree. And what I found was that it wasn't a fit for myself as well, financially, personally, and I was actually fired from that corporate job in a few years thereafter. And my wife and I decided, you know what, we need to go and do for ourselves. And so we started a small business selling to the federal government, and with the idea of achieving financial freedom in our lives. And what we found with small business ownership is a very grueling, taxing type of existence whereby you're working 100-hour work weeks and you're just kind of working it to the bone. So we actually sold that company in 2013. However, we started landlording, accumulating residential and commercial properties in the Washington, D.C. area. In 2009, we actually bought the building that we operated our company out of as our first investment. And what we were looking for from landlording was to obtain enough cash flow to meet our financial objectives in life and kind of work towards financial freedom that way. But what we found out was that the cash flow from landlording, although it was a great appreciation play, where you're paying down debt, as tenants are making their payments, it was not yielding the type of cash flow that met our financial aspirations. I'm speaking for my wife and myself. So we still own and manage those properties. However, we sold our company in 2013, and I was really just on a quest to find a true asset class that I can invest in time-wise, and that it would produce for me a freedom of time. So I kind of did a paradigm shift, where I was looking for financial freedom and money was the objective. And now I was looking for an investment that would yield me time in life. And so I found that with note investing, and it's been a perfect fit ever since. I've been doing this full time for 8 years now.
That's great. So, I want to talk about note investing later on in the conversation, but I did lead off this episode with the idea of helping homeowners stay in their home. And I know that right now we're recording this at November 30th, 2020. It's a tough time for borrowers right now. I mean, like I said, 7.6% are behind on paying their mortgage. What are you seeing? Well, first of all, how many notes do you have? And what are you seeing with those? Are your borrowers able to keep up?
Just to give you a sense on volume, we've purchased about $23 million in mortgage paper over the past 12 months. So we're pretty active in the space. As in terms of what we're seeing, we're seeing really two types of borrowers that are out there in this economy. Ones that really need to take advantage of what the CARES Act provides in terms of mortgage forbearance and relief, and another group of individuals, homeowners, that actually are seeing more value in their home because they're in their home more so. and they realize, hey, you know what? They may be telecommuting now. They may not have to ever go back to a job. And so they're learning to love and appreciate their home more than they used to. So we're seeing borrowers that in that group really, doing whatever they need to do to, keep paying and keep on schedule with us.
What are some of the tough conversations you've had to have recently with some of these borrowers who might find themselves behind?
The neat thing about what we do is because we purchase loans on the secondary market. So these are loans that typically came into a defaulted status while they were with a bank or hedge fund, and then they were bundled off and sold off to investors like myself. And so why I say that is because we actually have more flexibility when we're working with the borrowers to come up with creative solutions by which to help them maintain being on track with us, or just getting on track with us in general. So but in order for us to use the most creative solutions for the borrower, we need to understand the borrower. We need to have a relationship in place, and we need to understand where they are financially. And what we look to do in every case with our asset managers is first and foremost build a relationship with the borrower. Because if they don't trust you, if there's not this openness between lender and borrower, then it's not going to be, the solution's not going to be sustainable. So out of the gate, build the relationship. If they're coming on tough times, which many people are in the marketplace, then as long as we have a trust factor back and forth, then we're going to be able to work with them and figure some solution out.
So what does it take to build that trust factor? Is it just one-on-one communication? I mean, how do you get the borrower to trust you, and how do you come to trust the borrower?
It's very interesting. That's a very interesting question, because I'd like to say it doesn't take much, because the borrower has such low expectations for lenders in general. They're used to calling a call center and talking to a different person each time, being told different things by different people. And when you call into our company, you're going to be assigned to an asset manager. You're going to talk to the same asset manager the whole step of the way. So and you will be able to email with that person. You'll be able to phone call with them, at any given time. And so given that you have a single point of contact, that's really the starting point for the relationship. And we only hire and look for asset managers that are compassionate and genuine, because that right there is like the fundamentals of any relationship need to be based on that.
So Martin, are you servicing your own notes then through your company?
We use a licensed servicer for all our notes. However, we do our own workouts in-house with the borrowers.
How do you hold the borrower accountable? Because trust is a two-way street. How do you hold them accountable to make sure they're not just trying to pull one over on you, and that they will eventually be coming forth with some payments?
So given that, trust and relationship building is a two-way street. So if we see that, our outreach is not going anywhere and the borrower is not willing to engage in building a relationship with us, we're gonna use remedies through the servicer, through, in some cases, legal efforts to help bring the borrower to the table so that we can have a dialogue. What we find and what we strongly believe as a company is that there's a clock that's ticking on borrowers' accounts, and it's a per diem interest clock. And every day that a payment's not made, interest is being charged to the account. And in most cases, on a monthly basis, monthly late charges are being assessed on a borrower's account. And so we feel like it's our duty to go and connect with the borrower so that we can work with them to start paying down this obligation, so that at some point they'll have this home free and clear, something for themselves in retirement, versus it going the opposite direction and having themselves amass an even larger amount of debt.
You mentioned that you have more flexibility because you're dealing with the secondary market. You have more flexibility in working with these borrowers. Can you give us some examples of exercising that flexibility to help borrowers in their difficult situations?
Sure, absolutely. In some cases, a borrower might be working part-time, and then they're going to start picking up full-time hours in about 3 months. So we might give them trial payments that are much lower than the monthly payment, just to help them buy that extra time. If in some cases we have done other types of forgiveness options. We have for every dollar payment they made on time, we lowered their past due interest arrears by $1. In other cases, we're lowering the interest rate, to get the monthly payments down. But at the end of the day, we're really trying to find out what the borrower can afford, and doing our best to work with a plan that meets their disposable income, requirements to meet what they can afford at the end of the day. Because if we don't do that successfully, then we're going to give them a payment plan that's not going to sustain, and they're going to be in default all over again.
Give us a sense of the broad perspective of where we are now. Because of the coronavirus pandemic, there's a lot of uncertainty out there. What are you seeing now on the ground as far as opportunities with distressed notes? And what do you expect in the future?
So that's a great question, because, if you ask me if I believe that all the forbearance programs out there are going to lead to a downturn in our economy, I would probably say yes, because it's what's happening is they're going to, when those forbearance programs run out, and these lenders are going to be, doing a few things, right? They're going to be asking for reinstatement, all the money up front, lump sum. If these lenders are doing loan modifications, if they're large financial organizations, it's going to be a cumbersome process, and there's going to be many borrowers that fall out of that process. And what's going to happen is it's going to lead to an increase in foreclosure. And I believe that's going to be inevitable based on all this in 2021 over the next 12 months. And however, with that said, I think it's this goes back to relationship building and educating with the borrower, and letting them know that, hey, you know what, you can apply for forbearance, and we're going to consider that application if it's justified. However, you don't want to get forbearance just because it's a low hanging fruit, because it's gonna build up an amount of money that you're going to need to come and settle with once the forbearance program ends.
Yeah, so it's just delaying the payment and possibly increasing what you're going to owe over a period of time.
And the same thing with the eviction moratoriums too, is that's going to lead to a mass eviction. State legislatures and federal regulators, they're not going to be able to stave off eviction proceedings forever. At some point, something's going to come due, and it's I don't know. I don't know how that's all gonna work out, but I would say not well.
The story has not yet been written on how this is going to end up, but it will be interesting to see how it plays out. What do you anticipate as far as opportunities for investors in distressed notes?
I would answer that two ways. I think for individuals that and I actually do mentorship. I have a formal mentorship program, so I kind of get the benefit of seeing people coming up in the space, as well as dealing with large hedge funds that do $10 million trades, and so So I see really um, two different silos, if you will. One being the smaller note player that's in the space that operates more on a retail level. I see them. I see it just being about what it is right now, where there's very low inventory and prices are pretty high. And I see the mid-size players out in the space. I see them really cleaning up. I see them quadrupling in size and on up. And what's happening is a lot of those firms, and myself included, is we're building out our operations. We're building out our asset management team. We're building out, bringing on controllers, bringing on, operations managers, and we're squeezing all the juice out of the notes, if you will. So we're gonna take the distressed notes in. We're gonna create an exit plan with the bar, a loan modification for 30 years, and we're gonna service that note for the next 30 years. So it's a cradle to grave type scenario. Whereas before it would be more of a trickle down flow of things. So I believe it'll be that will be the case in the next few years.
Talk about your business and who you have on your team and how that team has changed over the past year. Because you mentioned, positioning yourself as a mid-level player. How have you positioned yourself and who have you brought on and what does your team look like?
So we're actually in the process of consolidating our operation. We have some individuals in Denver and we have, and I'm located in Virginia. And actually in the next 7 days, we're both sides of the fence. We've sold our homes and we're moving down to Sarasota, and we have leased a 3,500 square foot office space in downtown Sarasota. So we're all consolidating into that space, but just like any corporation, I mean, we have a controller with 20 years of experience. We have a team of 4 asset managers, and we're always hiring more. We have someone who we're looking at for an operations management. We have someone that does capital raise. And so we kind of cover all the different perspectives. In this day and age, if you start into this space, you need to grow, you need to scale up, because otherwise, it'll catch up to you at some point.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. If you're thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition myself, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB and Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you live in Michigan and are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com. This is a serious thing then. You're uprooting your family, moving to Florida, bringing people on your team from Texas to Florida. What is your short-term and long-term goal here? I mean, it sounds like you're scaling up pretty rapidly.
So we launched a $50 million income fund in March, literally the day before, the weekend before COVID shut down the country. So on March 13th of 2020, we launched our fund, and we had $3 million committed out of the gate. And all that just went away like immediately because everyone got scared. And However, we've managed to raise capital. We've managed to do well. We've put in $3 million into the fund, and it's growing. It's happening. So I see over the next few years growing that income fund as more people are leery of the stock market and just wants a reliable cash flow stream for themselves, because it's an 8% pref and it makes payments on a monthly basis. So some people are just looking for that steady, cash flow over the course of time, and as well as other. As far as people that are looking to come into the note space as a business for themselves, I would just say you'll need a lot more commitment and resources than you would have needed a few years ago, because regulation's a lot tougher. Licensing's a lot tougher. Just rules and regulations across the space are a lot tougher. And you need to have the resources in place to be able to understand all the requirements and perform accordingly.
Give us some examples of what you just said, licensing requirements being tougher and just the environment being tougher. What exactly can you point to?
Sure. Like, certain states, they require you to have a debt collector's license. Certain states require you to have a servicing license, have a lender's license. When we got licensed in the state of Illinois, we had to get a $20,000 audit of our company as part of the licensing requirement. Not only that, we paid $2,500 for the licensing fee in Illinois, and we had to go through a number of other steps. And that's just to receive our mortgage license to be able to purchase notes within the state of Illinois. So that's just one state. And each state has their own nuance. And it's up to that note investor or that note investing company to understand what those requirements are and assess risk and, start to, get licenses as they feel they need them.
I want to talk about the investing you are doing. You just started a $50 million fund. And if you don't mind, I'd like to dig into that because I'm somewhat obsessed with how people set up their funds. A lot of people have funds and everyone set them up slightly differently than the other. Yours, it sounds like, pays an 8% pref.
So it is a flat 8% pref. And it's what we consider, it's a 506C fund. So it's for accredited investors. And really how we classify it is as a high yield, low risk fund. So, I'm not your guy at 10%. I'm not your guy at 12%. It's, if you get those types of returns, God bless you. But there's always risk associated. All our notes that are placed into the fund are vetted and they are performing. So they are seasoned. And we carry a 65% investment to value percentage that we look for. And our fund is sitting at 63% right now for investment to value. So we have good equity coverage on our notes. They're well seasoned. And we actually have a full-time performing mortgage asset manager that actually just monitors, i.e., just looks over the whole pool and makes sure that everything's, performing how it needs to perform.
When you say you're at a 63% value or investment to value, be specific about what that means. What is it 63% of?
So if you have a property that's worth $100,000, then our mortgage is no more than $63,000 on that $100,000 property. So in that case, there's $37,000 of equity. So we can withstand a market downturn with a 20% dip in the fair market value and still be, solvent as a company with our portfolio.
Talk about the parameters of your portfolio. What type of assets are you investing in, and what's the price range, and what do you typically acquire them for?
We have first and second residential mortgages in our income fund. We also allow for a business notes to be in there as long as they're well collateralized. And however, business notes as well as any kind of private lending notes will not go beyond 25% of the total overall portfolio. So it's a majority of it is first and second mortgages. Now, in terms of acquisition, we may buy those in. The going market rate for purchasing reperforming loans, performing mortgages is about 13-14% yield. So if we buy them in at that yield rate and we're paying out our investors, then the spread is used to operate our fund.
It's a $50 million fund. It sounds like you've raised your first $3 million. So obviously it's an open-ended fund. You'll be bringing in more money as you go along. Are you bringing in money as you find the opportunities, or are you bringing in money whenever an investor is ready to invest?
And good point. So the name Bequest stands for legacy. So it's an evergreen fund with no expiration. And that was intentional. My partner, Sean, and myself, when we set this up, we said, we're not looking for an expiration. We're looking to grow this for ourselves and our investors and have it be a vehicle by which all of us in the investor family can pass it along to our children or other people. We can pass it down. So that's what this very, very much is, because a lot of these mortgages in our portfolio are 20 to 30 year performing mortgages. So they're, and we're always accumulating more. Now the fund is not leveraged. So we own our portfolio outright. When you invest into Bequest, you're an equity partner into Bequest, and we what we do is we bring on new investors, then we go to the marketplace and make purchases as a result to match up to the investments brought in. So that's kind of how we operate, to answer your question.
So what's your pipeline look like?
We've been on a buying frenzy. We're purchasing. We have a $2 million purchase coming up in 2 weeks on performing mortgages. Like I mentioned before, we've purchased about $23 million in distressed debt over the past 12 months. So from a buying perspective, we had just a frenzy during COVID, during the 6-month stretch of COVID when the country was really locked down, because we found some buyers that were backing out that normally would be involved in bidding opportunities. So we were able to take advantage of that. I'd say now, after COVID's kind of subsided somewhat, I know it's still out there depending on, everyone has their own view on it. So I'm not getting political, but what we've noticed is after the country has kind of reopened for the most part, we're finding a frenzy of buyers out there. So there's a lot of competition on note purchases right now.
That's great. And where are you typically buying from?
Buying from hedge funds, all from hedge funds. So we buy institutional paper. So we buy paper that was we buy QM mortgages. They're mortgages originated in financial institutions with Fannie and Freddie underwriting guidelines. We only buy that. We don't buy with contract for deeds. We don't mess with land contracts and this and that. So we buy from hedge funds whereby we have existing relationships in place with them.
As we reach the end of the year, are you anticipating even more opportunities coming along?
We just picked up a purchase of $900K in distressed debt. We were awarded last week. So we're running due diligence. We're going to close that trade along with the performing mortgage trade by the end of the year. But we've seen a lot of trades pop up over the past few weeks, and we're pretty pleased. And we know about a large trade coming in January, so we're kind of getting ramped up that way. So we anticipate a great buying year in 2021. But but that's only one side of the equation, right? I mean, you need to have the operations to be able to perform due diligence correctly and to service the assets. Because without having that a back office operation, what good is sourcing and bringing in opportunities to begin with?
And then you also, I know you have a kind of a training and coaching and mentorship program. Can you talk a little bit about that as well?
Sure. So it is, it's a very boutique setup. So I only conduct a few live workshops every year, and I limit it to 10 people. And the reason being is I believe that training in the note space you need to be selective. It's not about just taking any dollar from anybody that's looking to learn something. It's about finding people that are willing to set up a note business for themselves. So I price my training a little higher, but the quality is there. They come and spend 2 days and they learn about all my systems from someone that's buying tens of millions of dollars of notes. I mean, where else are you getting that from? And from that, I mentor a handful of individuals. And I'm proud to say that, some of the people I've mentored, I do deals with all the time. After, post mentorship, they're speaking at conferences and I'm just seeing, some of them, quitting their full-time job because they're doing well. And so I take a lot of pleasure internally from watching the success of some of these individuals, but some of them have become my competitors. So, but that comes with the territory.
So anytime I have a conversation with a note investor like yourself, I always like to ask about your greatest hits and your greatest failures. Can you give us an example of like a note asset that you bought where you just knocked it out of the park?
I'll tell you about one that, I'll tell you about my first note purchase and then I'll tell you about my partner's first note purchase. So when I came on the scene in 2012, 13 as a note investor, I put out about $240K and bought 10 first mortgage notes in Ohio, and I got smoked. I mean, it was like I bought at retail pricing. I bought properties that were junk properties. One had like a 7-foot diameter hole in the living room, like a sinkhole, and you couldn't even see the bottom of it. And so I got a few deed and lieu's and I got a couple of mods, and so I barely got out of that. And that was really a hard lesson. And that's where I really learned that when you're note invest, you need to focus on the borrower and their ability to pay as much as the property itself. When you come from a real estate perspective, many people come into the note space and they're just like property. It's all about the property because I'm going to get the property back. Well, how about I tell you this, Brian? We take back, through foreclosure, we take back less than 1% of our portfolio through foreclosure. That's how seldom we actually take back the property. In almost every case, we're modifying short-term payoff, something's happening, full payoff. So everything changed for me when I learned that. Focus on the borrower and their ability to pay as much as the property. Focus on the cash flow, not taking back the property. And the things you focus on are the things that are going to happen for you. And that is long-term streams of income. Now, Sean Munyo, my partner, is actually my first protege. He's the first person I mentored in 2017 after I wrote Note Investing Made Easier, the book that became a bestseller and kind of put me on the map, so to speak, which is a blessing and a curse. But he came to me. He's like, "Can you train me? Can you mentor me?" And I didn't have a training program. I didn't have mentorship. And I was like, "Sure." And he's just a rock star. He bought a note in his hometown. So he's from Denver. He bought a note in Arvada, I think, Colorado, which is a neighboring town to him. And he bought it was about 106K balance note, and he bought it for $40,000. And within 1 month of sending out like a legal notice saying, "Hey, this money's due," the borrower met him at a Starbucks and handed him a check for like $42,000. So he was made whole, all his investment, after about a month. And he had a 20-year stream of income at like $1,000 a month, something like that. And so the borrower made payments and then paid him off a few years after, and he got paid. And so that was a very profitable one for him.
Oh, that's great.
But that's a home run. I wouldn't expect that. If you come into the note space, don't expect that.
Yeah.
Out of the gate, at least.
Well, I think we heard your worst case with the sinkhole in the living room, but I didn't hear your best case in there. Like, what's your grand slam?
There's a note we purchased. The borrower was about 600,000, and we paid about 100 and change, and we got resolution on it. So I'll just say that.
Okay, that's great. That's great. Well, Martin, how would someone get a hold of you or find out more about you if they wanted to?
Sure. They can visit bequestfunds.com. That's BQ and then funds.com. They can visit Note Investing Made Easier, or they can just go to Amazon. I've written 5 books. So they can go to Amazon and just punch in my name, Martin Saenz, and they'll find a bunch of books that I've written.
And any parting advice for our listeners, anything you want to share with them going into 2021? And obviously you see great opportunities ahead, but what would you like to encourage our listeners with?
Focus on, with every asset purchase, focus on control and cash flow. Is it something you can control, and is it something that will cash flow? If it doesn't meet those 2 criteria, I don't mess with it.
What determines whether or not you can control it?
With our rental properties, I purchased a rental property. I can bring some value add to it. I can control the type of tenant that's in there, the cash flow situation, knowing all the expenses and debt service. With notes, you can control what purchase price you pay for it. You can understand the value of that asset before you buy it because you're performing full due diligence on the property as well as the borrower, and you can control the outcome of the performance given that you're doing asset management in-house. So everything that I invest with, I have control over the outcome for the most part, and it's something that will cash flow for me.
Fantastic. Well, Martin, I want to thank you for having this conversation with us and putting the mortgage delinquency problem in context with the pandemic that's going on, and talking about your note investing career, how you're helping people stay in their homes through communication and working with them and building trust. And then also just talking a little bit about your fund, how you structured that, and where you see note investing heading into 2021. Thank you so much for having this conversation with us.
Appreciate having me, Brian.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's higinvestor.com. And you can also ask questions and join us on Facebook by going to RPOA, Rental Property Owner and Real Estate Investor Podcast. This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.